Hi there, and welcome to TMC Connect. This is Tony Bramley. I'm the Business Development Coordinator here, and today we have with us Scott Weintraub, who is the Internal Audit Manager for MQMR. Really do appreciate your time here, Scott, today and your expertise. We're going to be talking about telling your story, fair lending, everything that comes in with fair lending, the fair lending program, and fair lending audits. This topic was top of mind to TMC lenders for our Pulse of the Industry survey, and we reached out to MQMR to ask Scott if he would lend his expertise to us today. So before we get started, I just want to say everyone has entered in as an attendee. But we do want you to engage, so please feel free to drop questions in the chat or the Q&A function, and I'll be asking those questions to Scott at the end of the presentation. As a follow-up, you will receive an email tomorrow with the not only a link to the video, as well as a copy of the slide deck that you're watching right now. And then Scott's also going to be talking about a few documents during this conversation, and we'll be adding those to the follow-up email as well. So thank you all so much for being here. And Scott, I'm going to turn it over to you.
Well, Tony, thanks so much, first of all, for inviting me to participate in the webinar today and for that great introduction. I'm excited to be here. So good morning, everyone, or good afternoon, depending on where you're located. It's morning for me still out in California. So I'm Scott Weintraub, as Tony said, the Internal Audit Manager for MQMR. And over the next hour, or really a little less than an hour, so we can leave some time for questions, we'll be talking about fair lending. As Tony mentioned, within the TMC community, this has been listed as one of the hot topics or something people wanted to know more about. It's also been a huge topic, I think always in our industry in mortgage lending, but particularly lately and with the current administration. So we thought it would be great to have this webinar today, and this is our agenda for the next hour. I will start by talking about why we're here and why this topic is so important. And as you can see, there's a couple reasons for that. One is generally, and we think going forward, there will be increased scrutiny and certainly regulator enforcement, not only from the federal level, but from the state level as well, related to fair lending. Included in that, or one part of that, will be what the disparate impact rule will be. And we'll talk about that a little bit later in the webinar and how that might be used or enforced now and going forward, as opposed to how it was used or not used over the last few years, for example. And then we'll talk about, well, if fair lending is so important and all of us who are lenders, or all of you who are lenders, need to have a fair lending program, what is that? What are the elements of a robust fair lending program? We'll talk about that as well. And a big part of any successful and effective fair lending program is performing data analysis. And so we'll be talking about that as well. How to perform that analysis, how often, and when we say data analysis, what does that involve? What does that entail? And then finally, at the end, I want to talk a little bit about what your data is. And in particular, that at any lender, your data tells a story. So here's what I mean. I'm very confident, not even knowing who all of the different lenders out there who are on this webinar, I'm very confident that none of you are certainly not purposefully discriminating and may not be discriminating at all against any minority or protected class member. But nonetheless, your data does tell a story. And in fact, I want to think about it in a more positive level, not just making sure something negative like discrimination isn't happening, but how can your data provide you with opportunities, either for increased revenue, opportunities for partnerships in serving the communities in which you lend. There are opportunities that abound, even from thinking about your fair lending data and your fair lending program. So that's our agenda for the next hour. So with that, then let's start a little bit about why are we here? Why is this topic so important? Well, as I mentioned, the first thing is from the federal level, there will be an increased level of focus, scrutiny, and enforcement related to your fair lending program. And I want to give you a couple examples that we've already seen just over the last 6 months. So the first is, we all know, of course, starting in January, we had a new administration that took office with President Biden. In President Biden's first week on the job, on January 26th, he sent a memo to HUD. And you can see I've quoted a little bit of that on this slide. And for example, one of the things that the administration feels is that there is a strong role for the federal government to play in both ensuring that discrimination in mortgage lending is not going on today, but to think about and address the history of discrimination that members of particular minority or protected classes have seen and felt and experienced. So what I want to highlight is something that was in this memo that was sent to HUD, and that's in red on this slide. That what the Biden administration wants is that the federal government, including HUD, should work with communities to end housing discrimination and to provide redress to those who have experienced housing discrimination, and look at the broad language here, eliminate racial bias and other forms of discrimination in all stages of home buying, which of course includes the process of getting a mortgage to purchase a home. So when we say there's an increased level of focus, I think that is combined with the fact that this was painted in this memo with a very broad brush, and that what the government will be looking to seek to do is to think about this in any or all aspects of ways that a lender might be doing something that might not only discriminate overtly, but something that might seem neutral, but would have a discriminatory impact or effect on a particular minority group or protected class. And so that, I think, is a good lead in to the second thing that's happened over the last 6 months. And this just happened last month. So on June 25th, HUD announced their plan to restore a rule that was put in place during the Obama administration in 2013 called the disparate impact rule. And during the Trump administration, that rule was sort of taken away, or it was said that it would not be enforced. But HUD now has published its desire to put the disparate impact rule back into effect and enforce it. So what does that mean? Well, it would be easy to say if a lender had a policy that said, we don't offer loans to this particular group of people, that's overt discrimination. That would be called disparate treatment, treating a group differently because of their race or their gender or their ethnicity, or any of a host of protected classes that are outlined in the various federal laws and state laws that govern mortgage lending, such as, for example, the Fair Housing Act and the Equal Credit Opportunity Act and its implementing Regulation B. The disparate impact rule is something different. That says that even if a particular policy or procedure or practice at your organization is neutral on its face, meaning it's not a practice that says we don't make loans to this particular group of people, but if there is a policy or practice that has an effect, the impact of it is that there might be a member or members of a minority or protected class that would be impacted more negatively than the majority class, then a lender could still be held responsible for that, especially if it's shown that there was a more non-discriminatory way, or a way that would be less impactful that a lender could have used. But instead they chose to use this policy or practice that did have a disparate impact or discriminatory effect. So even if nothing was intended, a lender could be in a situation of being held responsible for something. And as we just saw with the memo Biden sent, not only is the government interested in rooting out this discrimination, they're also interested in providing redress to victims. So that's a second part of it. What might happen to a lender in terms of consequences and what they might have to do for impacted borrowers if something were to be found. So when we think about why we're here, those are two big examples just over the last few months of why fair lending will continue to be such a hot topic, I think, in our industry. So having said that, we can move on then to the next section, which is knowing this, knowing how important fair lending is, knowing how important from a regulatory perspective it is. How can you comply at your organization? So what I mean by that is, how can you ensure that at your company, you have a robust fair lending program? Well, so it starts with spelling it out. It starts with writing it down in your fair lending policy. So that's the first or sort of overriding element of your fair lending program, is having a robust fair lending policy. And as you can see, we've listed on this slide, what are the different elements that make up an effective, sufficient, robust fair lending policy. So the first thing that you'll want to make sure you have is that you have designated someone to be the fair lending officer for your organization. Now, that person could have other roles. For example, it could be your company's compliance officer. So it could be a role that is part of that employee's larger role. But the important part about it is, whoever you will designate as your organization's fair lending officer, that person should have some relevant experience, should have had experience with some fair lending tasks, so that when they're the fair lending officer for your organization, they will have the knowledge and experience to carry out your organization's fair lending program. That's one of the biggest things about what the fair lending officer does. Her or his responsibility is to not only implement and maintain this policy, but to make sure it's carried out at all levels of your organization. So what do we mean by that? One thing we mean is, if your company has a board of directors, they need to be involved in this. And or if not, your executive management needs to be involved as well. And that means they need to be aware of what the company's policy is. They ought to be reviewing it and approving it. We'll talk more about that later on in the webinar. And we'll talk about things like training for employees as well. That ought to include your board of directors and executive management. They ought to be taking fair lending training on an annual basis, and whatever trainings might get updated to supplement that over time. That's one thing we see with a lot of companies that we work with and audit. That training may go out to employees, but it's not happening at the top. And for example, the CFPB is one entity that will be asking you specifically, what trainings are your executive management and board taking? And fair lending is one that they'll be looking for specifically. Another thing you can do is that there ought to be some sort of risk assessment that your company does related to fair lending. And for example, that could be done internally at your organization, or through a third-party audit or risk assessment organization, a company like MQMR, for example, to see what is the state of your fair lending program currently, or where might there be opportunities to enhance what you're doing, or where might there be holes. Just as one example among many, are you tracking exceptions that are made to pricing or to underwriting guidelines and decision making? And even if you're tracking it, are you reporting on it and sharing that reporting? And are you perhaps taking actions depending on what your reporting tells you? That could be an example of an area where there could be opportunities to enhance what you're doing. I mentioned training earlier. You'll want to make sure that fair lending is an example of a training course that all employees take within your organization. Why might that be? So, for example, not only is it your sales staff who would be taking applications from borrowers, there is your operations staff who would, for example, be underwriting loans and moving them through your system. There's your management, your executive team, your board of directors. There is also, even for example, employees like in marketing and advertising, who sometimes what we see with companies is they aren't required to take all of the different training courses. But when you're marketing your company, that's a big area where there could be fair lending issues. And we'll talk about that a little bit later. But I want to make the point now, fair lending is an example of a training course that should be provided to all employees. And also, for example, I know that many lenders, if not most of them or all of them, use some third-party online training sources. That's fine. And there are some good resources out there, some good companies that provide some really good and effective fair lending trainings. What I would add to it, though, is one thing about those off-the-shelf online training courses is that they're generic and they talk about what the fair lending laws and rules are and how that might apply to an organization generally. What you'll want to make sure of is that you supplement that training with something that's specific to what your company does and how your company ensures that you're not discriminating. And as the slide says here, in addition to just offering the training to employees, that training should be documented and tracked to ensure that all of your employees complete it by whatever the deadline is that you provide to them. And not only that, but if you're tracking it and monitoring, there needs to be consequences. In other words, what happens if employees within your organization don't complete fair lending training requirements by the deadline that's provided to them? Your policy, your fair lending policy, your training policy should have something there that says there would be some kind of action taken with an employee who doesn't complete the training by the deadline that's provided. Okay, so that's training. Another important part of your fair lending policy and program ought to be what we call internal controls and monitoring. So in other words, you have a policy that spells out in writing the fact that your company doesn't discriminate, right? Either overtly or even with disparate impact. You provide that policy to employees and you follow that up with training that employees take specifically related to fair lending at the time they're first hired on an ongoing basis as well. All of that is great. But what you also want to make sure is that as your loans actually proceed through the process from application or really even before an application with marketing, all the way through funding of that loan and even into servicing of that loan, as we'll talk a little bit more about later on, that you have the right controls and monitoring in place to ensure from a fair lending perspective that all applicants and borrowers are being treated equally and fairly. And so as you can see on this slide, there's several steps that you'll want to make sure you take a look at. So one is, again, right up front, when you're marketing yourselves to potential consumers and they're trying to get qualified, and then all the way through the process of a loan being underwritten and the decision that your company is being made, that is being made related to that borrower's application. And then also the pricing for a loan. So even once a borrower is approved, what is that borrower having to pay in terms of interest rate and or fees to get that loan? Thirdly, what about exceptions? Either to underwriting guidelines themselves or your investors' guidelines, or to pricing. Does your company allow exceptions? If you do, what is the criteria? What is the process for that? Who needs to approve it? And does everyone within your organization know that and understand that? So if there's a borrower over here and another borrower over here, if they both might qualify for an exception, that they would both get the same result. And that's a really key thing all the way across the board with fair lending. What a regulator will be looking for is that similarly situated borrowers will get a similar result. And we'll talk more about that as the webinar goes on. Lastly, on this slide, there's the second look process. So if a borrower is denied for credit, are you having someone, for example, an underwriting manager, taking a look at that loan again before the denial letter would go out to that applicant? So those are some of the internal controls and monitoring that are an important part of your fair lending program beyond just having a policy and training employees. So next, I mentioned reporting. So whether it's underwriting exceptions or pricing exceptions, are you reporting on those? For example, would you be able to know if someone were to ask you in a particular month, how many exceptions were asked for, either to underwriting guidelines or to loan pricing? And of that number of how many exceptions were asked for, how many were approved? How many were denied? Would you be able to report on that? Further, would that reporting tell you the race, ethnicity, gender, age, for example, the areas at which the government will be looking? Would you be able to have data that would say for the exceptions that were approved or denied, this is the breakdown of that government monitoring information, the GMI data? Would you be able to know the answer to that question? And if you have that reporting, with whom are you sharing? And what kind of discussion related to exceptions? And are there any action steps that your company might take based on what your data and reporting is telling? So again, that's a really good example of how as loans go through the system and things like that happen, you want to make sure that you're tracking it so that you can report on it and so that you can share it. And so if there's a need to do anything, to make any changes to your process or your policies, that you'll be able to do that. Again, important parts of internal controls and monitoring. Another important aspect, and I mentioned this when we talked about board of directors and executive management, as part of your robust fair lending program, is corporate governance and, of course, additional reporting. So when we talk about corporate governance, what we mean is you should be making sure that if you have a board of directors, they are being updated, and your executive management team, that group as well, that they are being updated on at least a quarterly basis related to your fair lending program and policy. And so, for example, when we talk about that, what type of reporting might that include? What would be included? Well, here's some specific examples of what could be included when updating executive management and or your board of directors related to fair lending. For example, we're going to be talking about data analysis and what type of analysis you should be performing on your data and what to do about it. Those results can be reported up to executive management or your board of directors. What about the regulatory landscape? We talked earlier in this webinar about how there's a lot greater enforcement and scrutiny that we can expect with this current administration. And we've seen their emphasis on it just over the first 6 months that they've been in office for what they will be expecting the government to do to, in their words, try to eliminate all racial bias. So what is the regulatory landscape and how might that affect an organization, both internally and when they have audits and exams, either at the federal or the state level? And speaking of exams, if you've had anything that might relate to fair lending, either an exam where the regulator told you there were no issues, or if there might have been any issues or questions or concerns that came up, to report that up to your executive management or board. Or another way you might find out about allegations of discrimination are from consumer complaints or from litigation that your company might receive. Those are also good places where fair lending allegations can be made. Also, as part of your updating to the board and or executive management, what action steps might you be recommending based on anything that you've seen as part of implementing and maintaining your company's fair lending program? And then also what your executive management or board of directors can be doing is on an annual basis, or more often if you make any changes, to make sure that the exec team or your board is reviewing your fair lending policy, again, on an annual basis generally, and that they're reviewing it and approving that policy each year. And that's something you'll actually want to put in your document, in your revision history, that each year it's been reviewed and approved again by executive management or the board. That's all part of corporate governance and what you might be reporting. One way to do that, or something that we recommend or that we've seen a lot of companies do, is they establish a specific committee related to fair lending. And members of executive management and or the board can be part of that fair lending committee. It could meet, for example, on a quarterly basis, and it could go over all of the things that we talked about on a previous slide. And that would show a regulator the commitment that your organization has made specifically related to fair lending, that you have a whole separate committee that talks about. That's one example of something you can do. Another important element, and we've mentioned it a couple of times, is change implementation. It's one thing to say we have a policy, and not only that, we provide training to our employees, but over the course of time, you may see something within your organization. You may see data results. You may see something in your reporting or tracking of things like exceptions, for example, that might lead to a conclusion that there's a potential risk or maybe an actual risk of something that's happening at the organization that might be disproportionately affecting members of a minority or protected class in a way that's above your tolerance for risk, in a way that might be statistically significant in your data analysis. When that happens, what might that mean to your organization? Well, what it means is you would want to think about implementing changes. if there is a particular policy or practice that is impacting minority or protected groups, especially if it's in a statistically significant way, then your organization might want to think about, is there a different practice that we could use that could still help us achieve our organization's goals and strategic objectives, but that might be less impactful in a negative way for a particular group. One example of that that's been something people have talked about historically a lot is, for example, having minimum loan amounts at your organization. In different areas in the country, that can mean different things to potential applicants if there's a minimum loan amount. And in some cases, that type of policy or practice has had a disproportionately negative impact on certain minority and protected classes. Not saying that's the case right now at your organization, but historically, that's been something that has impacted a lot of companies, and it's been a big topic from a regulatory perspective and from consumer advocacy groups. So, for example, if you notice in your day-to-day workings of originating loans, or in the data analysis and reporting that you're performing, that something might be causing a disproportionate impact for a particular minority group or groups, then you'll want to implement some changes to have policies that might be less impactful or less disproportionately impactful to a particular protected class. And so we've listed on the slide some examples of what those changes might be and what they could include. So for example, any change you make, you'd want to make sure your policy and procedures related to fair lending are updated to match what the changes are. You might make changes to your underwriting guidelines or your decision-making process or to your exception process. The same thing could be true for pricing, your pricing guidelines or your exception process related to pricing, whether that's related to fees or interest rates or both. And then also, for example, if your organization doesn't have a second level review process for loans that are denied for credit, that would be a great recommendation of something that you could add to make sure that before that denial letter goes out to an applicant, that someone's taken a second look to make sure that the decision was right, or that there might not be a way to structure or restructure the loan to make it work, to again, all drive towards the same goal, which is that all applicants or borrowers with similar credit profiles receive similar results. It's a really good sentence to think about. When I think about fair lending overall, what are we trying to achieve? That's what we're trying to achieve, that people across all racial, ethnic, gender, age classes who have similar credit profiles are receiving similar results, which means at the end of the day, that's all that your decisions are being made. The credit worthiness or lack thereof of the applicant, and not, of course, any prohibited factor like race, ethnicity, or gender or age. Here's some other examples of changes that your company might implement based on what you've seen in your fair lending program and all of the things that are part of that. You might need some system enhancements, either, for example, to help you identify some outlier loans. I'll get back to that in a second. Or maybe you need more training for employees that deals more specifically with how loans should be made at your organization. Or what could be done in terms of products that are being offered to potential borrowers, disclosures that are made to applicants. These are all examples of changes you might want to implement. So one point on what is an outlier loan, that would be a situation where you have two borrowers. One would be a member of a majority group. So for example, a white male, non-Hispanic, under the age of 62, versus a second borrower who's a member of a protected class, such as an Asian American borrower, for example. If you have the majority group borrower who is approved for a loan and the minority applicant was denied for that loan and their credit profiles are the same, right? And they're in, same state, same type of loan amount, their FICOs are the same, everything looks the same, but the minority applicant was denied when it looks like they ought to have been approved. That's an outlier loan. And when we get to the data analysis section, we'll talk a little bit more about what analysis could help you figure that out, and then what to do about it if you actually identify some outlier loans. Before that, though, again, keep the disparate impact rule in mind. that will likely be enforced going forward. It's not just making sure you don't have a policy that says we don't lend to this group of people. That's obviously easy for anybody to find as a problem. But it's what policies, procedures, or practices you might have that might have an impact on minority groups that could potentially cause a risk of an issue that a regulator might bring up to you. So make sure you keep that rule in mind as you think about what type of fair lending program do we need. So now let's talk about something we've been alluding to throughout the webinar so far, which is fair lending data analysis. So we'll talk about it in two ways. One is what to do. So what do we mean when we say fair lending data analysis? And also, how do you go about doing it? So when we say fair lending data analysis, one thing that we recommend, and that I think regulators would be looking for, is how often ought you be doing it? Well, performing fair lending data analysis on a quarterly basis will allow you to make sure you're showing a regulator that you've made that commitment to looking at your data regularly. So you have 3 months of data every time you perform quarterly fair lending data analysis. So that's one thing. How often do you? There are two aspects of your process that you want to make sure your data analysis is including. So there's really two big umbrellas. One is the decision on the application. Is that applicant approved for credit or not? And then secondly, it's the loan pricing. So for applicants who are approved, what is that applicant paying, or now borrower? What is that borrower paying in terms of fees and or interest rate to receive that loan for which they were approved? Those are the two big areas that you'll want to make sure your data analysis is encompassing. So now we know what to do and how often we recommend that it be done. Well, how should that analysis be done? So when we say you ought to perform data analysis, what does that mean? What are we looking at when we analyze data? So you'd want to start at the top. And when I say at the top, to get an overall view of your entire portfolio. So let's take a minute to talk about what that means on the application decision side and on the loan pricing side. And all of the data points that I'm talking about are ones that now all lenders are required to provide to the federal government as part of your loan application register to comply with the Home Mortgage Disclosure Act. So first, when I say your entire portfolio, your loan application register data will be able to tell you for each racial, ethnic, gender, and age group, for example, what percentage of applications for each group were approved versus what percentage were denied. And you'd be able to see that for your entire portfolio. On the pricing side, you'd also be able to see, for example, what was the average APR? What was the average interest rate? What was the average amount paid in terms of fees for each group, for each racial, gender, ethnic, and age group? And so you'd be able to get a sense from your entire portfolio, is there a particular minority or protected class group that is faring worse than other groups? We're going to talk a lot more about that towards the end of the webinar. For now, I want to make sure you're starting by getting that high level look at your entire portfolio. Then after that, you want to break your data down. And so the question is, why do you want to do that? Well, even if if you look at your entire portfolio, even if that tells you that there isn't necessarily a potential risk or issue, or that there isn't necessarily a statistically significant difference in results from one protected class versus the majority group, there might be when you break your data down. So one way you can break it down is you can look at purchase loans and refinance loans separately. As we know, for example, in 2020, based on what was happening in the market, there were a much greater percentage of refinance loans. Certainly something your organization might want to take a look at separately from the purchase loan population. Or if your organization not only does conventional loans, Fannie and Freddie loans, for example, but you're also doing government loans, FHA and VA loans, those are different types of loans. And you could break your data down and look at conventional loans separately from government loans. Another way you could break your data down is based on geography. It may be the case that depending on what your geographic reach is, for example, if you lend in all 50 states plus the District of Columbia, there might be different elements of pricing, or there might be some different guidelines that you have in some states versus others. And there might be legitimate, non-discriminatory reasons for those differences. But you will want to break your data down to see if any of those state-specific type of guidelines or practices might be causing differences in the outcomes, either on the decision side or the pricing side, for especially if that outcome disproportionately affects a particular protected or minority class group. Or if your company is a retail shop and you have all kinds of branches all over the country, there might be different things in terms of pricing, for example, at some branches versus others. And especially to the extent that you have enough branches that have significant levels of volume, that it would make sense to break your data analysis down. You could break it down by branch office. You could break it down by loan officer as well. Again, especially if there's enough volume coming in from some of your loan officers that it would make sense that you could break it down by loan officer. All of these are ways to take a deeper dive look at your data to see if and where there might be an issue about which you'd want to have conversations. Finally, for those of you who are wholesale organizations or have a wholesale channel, you might be able to break it down by broker company or individual mortgage broker, again, to the extent that the business coming from that broker company is large enough that it would make a difference to be able to break it down by broker. All of these are different ways for you to find out information about your data. And then, as we'll talk about at the end, how your data tells your story and what you can do with that story. So that's some examples of what your data analysis can include. Now, what if by doing that, you find that there might be some results that you think might be statistically significant, or maybe you're using a fair lending software system, or you're using a company to help you do it, and you're told that some of your results that are worse for a protected group, and those results are statistically significant. What do you do then? Well, you can do something that's called regression analysis. And what regression analysis does is it tries to level the playing field among different groups of people where not everything is level. And so, for example, we've listed some credit factors that an organization can take into account that might help explain what at first blush or initially looks to be statistically significant results from a protected or minority group versus the majority group. These are things such as the borrower's FICO score, or their debt to income ratio, or the loan to value ratio. So let me give you an example of what that means. If there was a lender who hypothetically, their data would show that the majority group had their applications denied 30% of the time, but then there was a minority group, a protected class group, let's say their applications from that group were denied 60% of the time, twice as often. Well, that looks like something at first blush that somebody might want to ask some questions about, including a regulator. But then let's say you were to look at your data further, do some regression analysis, and you were to determine, for example, that for that protected group, their FICO scores were significantly lower. The debt to income ratio and the loan to value ratios for that minority group were significantly higher. The point of doing regression analysis is to find the explanation for your disparities in results, particularly statistically significant disparities. And so a company might find that what at first blush looked like a big difference, a statistically significant difference, could be explained by non-discriminatory means. Again, such as credit factors like FICO, debt to income ratio, loan to value ratio, something that could show a regulator, for example, that the differences in results were based on credit and not based on anything else. Well, what else could you do? Particularly if you find that the regression analysis does not fully explain the differences between a protected class group versus the majority group. Well, what you could do is then do something called comparative firing. And what you'd want to do there is, again, try and find those outlier loans. Loans where a member of a protected group had a worse result. Either they were denied when it looked like they could have been approved, or if their pricing was higher when it looked like it could have been lower when compared with a majority group borrower who was similar from a credit perspective. When you find those matched pairs, you're going to want to look at those loans side by side. So for example, why did the majority applicant get approved and this minority applicant over here get denied when it looks like their credit was the same? Why did one, particularly the one in the protected class, why did that person get a worse result? And you'll want to go down, if you need to the individual loan level to see what is the explanation. And if you can find it, then that's the answer. And if you can't, that might lead you to go back to that discussion of change implementation for how you might want to change it to eliminate that potential risk going forward. So a little bit more about how can you actually perform this data analysis, or who might be able to help you do it. The first thing you'll want to do is start in the place where the CFPB would start. And that is making sure the data that you have before you start analyzing it is accurate in the first place. Crucially important to make sure you're working with accurate data. Otherwise, the results that get spit out will not be accurate. So that's what we call a HMDA LAR data integrity review. So what that would do is it would compare the data that you report on your loan application register to comply with the Home Mortgage Disclosure Act to the government. It compares the data that's on your LAR to the actual documentation that's in your loan file. So for example, if for this particular loan, you're reporting on your LAR that it is an African-American male borrower, whatever the age is, you'll actually want to look at the 1003 for that loan and make sure it matches what you've reported from a data perspective on the LAR for that loan. And so, for example, if you find that there are discrepancies and it's actually in the examination guidelines from the Bureau, what percentages of discrepancies might cause you to need to resubmit your LAR. But from your perspective, as important as that is, what's equally important is you want to know if your data is accurate before you start analyzing it and then doing something potentially about the results. So you want to take that step first if you're not already doing it today. Is the data that's being reported on your LAR accurate? Meaning, does it match what's actually in the loan file? That's a big part of the analysis that in a fair lending exam, the CFPB will do themselves. So you want to make sure you find anything, of course, before they do. So then when we talk about analyzing your data, percentage of loans that were approved versus denied, what was the pricing in terms of APR or interest rate or fees? Were there statistically significant differences? How can you do that? Well, there's many different fair lending software programs out there that could help you do it. Many of them are actually integrated with LOS systems that your company might be using. There's third-party vendors that are out there who could help you do it. Or you could do this internally. Even Microsoft Excel has a way to do a lot of different types of data analysis. So again, you could do it internally. You could use some software that you might already have, for example, or there's a lot of different third-party vendors out there that could help you do it. What I would say now is if any of you have any questions or want to talk or chat about data analysis or really anything else, obviously, that's in this webinar, please feel free to reach out to me. You'll get my contact information as part of this presentation, and I'd be happy to talk with you about how you could go about performing data analysis or anything else, of course, that we've talked about today. And then one last point to mention is for those of you that service loans, that's also a big emerging issue, particularly at the federal regulatory level. When thinking about borrowers who might apply for loss mitigation, could lead to maybe a loan modification or maybe other things if that doesn't work, deed in lieu, short sale, foreclosure. What outcomes are there for borrowers who might not be paying on their loans? And are those applicants for loss mitigation outcomes being treated fairly and equally? So again, are two borrowers in different racial, gender, ethnic, age groups, but with similar credit profiles, similar credit histories with their loan that's being serviced by your organization? Are they getting similar results? And even if you're using a sub-servicer, you'll want to have oversight over them and monitor them. What are they doing to ensure fair lending? What kind of data analysis is the subservicer doing? What kind of reports are they giving you, if any? So again, the data analysis and fair lending actually extends into fair servicing as well. And it's becoming a pretty hot topic also, and has over the last couple of years. Okay, so the last section of the webinar today is what I call telling your story, meaning how can you use your fair lending data as an opportunity for your organization? So again, not just ensuring that something bad isn't happening, but how can you use your data as an opportunity to help your company achieve goals and objectives, and even to help it grow? So your story starts even with just basic information that you can find in the summary page of your loan application register. So what do I mean by that? What does the even basic data tell you? Well, it tells you, for example, what percentage of your company's applications come from each racial, ethnic, gender, and age group. Just the applications you're getting in the door. How is that broken down by different groups? And for example, you can compare that number to something. How does each group percentage of applications that your company gets compare with that group's percentage of the population in the US? You can use census data, easily Google to get. So for example, how many applications does your company receive from Asian Americans or Hispanic, those who would identify themselves as Hispanic for their ethnicity? What is your percentage of applications? How does that compare to how that group is represented in the population of the country? And then moving on, what percentage of applications were approved for each racial, ethnic, gender, and age group versus what percentage of applications were denied for each racial, ethnic, gender, and age group? Again, you can look at that very basic data. Who was approved, who was denied, and how often? And again, think about APR or interest rate or fees. What was the average for each group? And then you can compare that to each other, or you could compare every protected class group versus the majority group. And lastly, with fees. So again, on the pricing side, APR, interest rate, fees, how does one group compare to another? All of these things are very basic information that your data will tell you before you even do any in-depth data analysis. That's the beginning of your story. And so, for example, your story is a narrative. And that narrative is controlled by only one entity, which is you. It's controlled by your organization. And no matter what your data tells you, you have the opportunity to change the narrative and use your data to tell your story in a positive way. So look what it says at the bottom of the slide, for example. What if your data shows that for all of those different questions that were on the previous slide, applications that are received, applications denied, higher APR, higher interest rates, higher fees, what if your data told you that there was one group and that group was a protected minority class group? What if there was one group that was consistently performing the worst for all of those questions that were on the previous slide? If that was true, what would your company do about it? Well, instead of looking as a negative, you can change the narrative. You can look at that as an opportunity. For example, your company could conduct outreach or market yourselves in areas where that particular protected class group is well represented. As part of your overall marketing and advertising scheme, that would of course encourage all borrowers of all racial, ethnic, gender, or age groups to apply, but that you could particularly try to look to ways to make sure you're conducting outreach and marketing in areas where those particular groups might be well represented. Again, as an opportunity, more applications coming in the door could mean more applications getting approved, could also level out the pricing playing field. It's something that you could discuss if you're a retail shop with your branch offices, the branch managers, with individual loan officers, or what if you're wholesale? It's something you could discuss with your broker companies, particularly, by the way, if there are some that might have a large enough volume that you saw some results with them. I can tell you from my experience that brokers would love getting that feedback, including letting them know where there might be opportunities to increase from where they're getting applications, from where they're getting potential applicants and borrowers. Also, you could look at partnering with consumer groups that might have some ideas or programs that you could hook into to try to, again, increase the amount of applications you're getting. That could, in theory, increase the amount of approvals you're able to have. Also, you can be reviewing your guidelines. Are there any other methods of maybe trying to qualify borrowers that might work with your own guidelines, your own tolerance for risk, your investors' guidelines or agency guidelines? Might there be things that could be tweaked or added to again, try to provide more opportunity within, of course, acceptable guidelines for agency, compliance requirements, and investor guidelines? But might there be some alternatives that, again, could allow for increased opportunity for applications and approvals, and perhaps pricing as well? So again, the point is your data tells a story and you can impact that story in a positive way for your organization. So one of the other things we want to mention is, in order to make sure that everything we've talked about over the last hour is not only part of your fair lending program, but that it's sufficient enough to pass muster with federal and state regulators alike, you could have an independent review of your fair lending program. So you could have a third party, for example, come in and ensure that your program, again, not only meets all requirements, but that it's working as you intend it to. And it could be a part of your company's internal audit program. And here's just a partial list of what that independent review of your company's fair lending program could include. Obviously, starting with compliance. Is what your company has in place sufficient to fully comply with all federal and state fair lending laws? There are some states out there, New York and Massachusetts immediately come to mind as having their own fair lending laws. Also, it will help evaluate how effective your particular organization's fair lending program or policy is, including all of those bullet points that are listed on that slide. And then these are the different parts of your company's departments and processes, including the loan origination process, that could be reviewed. Your product offerings. We mentioned marketing and advertising, including social media, a big way that people can find potential issues. How are you marketing yourselves, and are you marketing it to everyone? The decision process, including exceptions, the second look process, and of course, pricing, including exceptions. And then, are you doing the right data analysis? Are you doing it often enough? Including regression, if and as applicable. All these different elements could be part of an independent review to give your organization that validation that you want. So really to end, how can we help? And so again, we'll hang on for a couple of minutes in case there are any questions, but beyond this webinar session today, you can always reach out to MQMR and you can reach out to me. We'd be happy to help you with any or all aspects of this. And we'd look forward to a conversation about how we could take your already great company and help it operate even more effectively. So with that, Tony, that was the information I had today. So again, thank you so much for having me, and I'll turn it back over to you.
Great. Well, thank you so much, Scott. Just an exceptional wealth of information that just truly, truly appreciate you and your time and partnership with MQMR. Thank you guys so much for stepping up and giving this information for a hot topic that's top of mind that I'm sure lenders are losing sleep over. So we really do appreciate it. And, you know, one of the things, and you've reiterated it several times throughout the discussion, was that, you know, all applicants with similar credit profiles get similar action and outcome. You know, exactly. That's what that all boils down to. And there are a lot of moving parts to make that happen. And I know that you can help any of the lenders that we have on the phone to ensure that that happens. And so really do appreciate your time. Thank you all again for being here today. This is TMC Connect. I'm Tony Bramley. As a reminder, you will get a follow-up email tomorrow with a link to the video for this particular session, as well as attached documents that Scott referenced during the call. If you've got any questions, I did drop Scott's contact information in the chat. So
Thank
feel
you.
free to reach out to him or reach out to your member engagement team or myself or Tom Galucci, and we can always get you in touch with our folks and our friends over at MQMR. So thank you guys so very much. Happy Monday. This is a special edition of TMC Connect, and we truly appreciate you being here. Thanks. Have a great day.
Thank you, Tony. Thank you.
Bye-bye.
Bye, everyone.